The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The vibe shift for U.S. markets grabs hold of small cap stocks. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Matt Miller. We're kicking you off to the closing bell here in the U.S. to get a check on what happened in the stock markets this morning. I was here for the open, and I'm going to close it as well. I like the Dow Jones Industrial Average. We're going to talk to Ankur Crawford in just a moment, and she says cyclicals could outperform here if you get the rate cuts that we're looking for. And Scott Bahnsen told us this morning we need 50 basis points to kick us off in September. The 10-year yield down to 424, and really the whole curve has fallen. We saw some steepening this morning, and it's flattened out this afternoon. Bitcoin up to what would be a closing record if Bitcoin closed. I'm pretty sure it trades 24/7, but we're not the highest we've ever been, because that was Monday at 122.3. Right now we're at 121.6. Still pretty impressive for nothing but a line of code. And then the Bloomberg Dollar Index, which is supposed to be more, backed by the full faith and credit of the United States of America, our gigantic military and the Saudi Arabian oil complex, down again to 1201. And if that dollar continues to weaken, then investors are going to expect the U.S. rest of world valuation to continue to shrink, Romaine.
Dollar a big story on the day. So too is the VIX back below 15, and so too is the Russell 2000. A third straight day of outperformance by the small cap cyclicals, indicative of a vibe shift as benign inflation bolsters assets to the point where that Sell America trade, remember that? Well, that looks quaint right now. And maybe, though, not necessarily misguided. Take a look at the new Bloomberg Markets Pulse survey that just came out. It did show lingering concern about tariffs, but it did also show that sentiment out there that lower interest rates can actually blunt that impact and maybe lift stocks. Now, one of the big tells on that front is to take a closer look at the bond market, a re-upping of the bond rally with that CPI report yesterday spurring fresh bets on Treasury price gains, a trade that's intensifying this Wednesday. Conviction now higher that the Fed will move borrowing costs lower, and what that man, Treasury Secretary Scott Bessent, says should be the start of a dovish policy cycle. Here he was earlier today trying to jawbone that scenario.
150, 175 basis points lower. So, I think the committee needs to step back.
Of course, stocks are going to need a little bit more than just rate cuts. The main pillar of this equity rally still is the AI trade, and we are seeing some cracks there. Data center stocks sliding this after CoreWeave's earnings showed that the high cost to build AI infrastructure, well, it's still outpacing profit returns. Applied Digital and Supermicro being dragged down today, and so too, Matt, is Cisco, which of course is trying to nudge its way back into the AI ecosystem. It reports after the bell.
Yeah, and this is one company that knows a thing or two about spending way too much money for returns. We saw that in the dot-com bubble burst. I'm also looking at the MLive Pulse respondents here. You can get that, by the way, on your Bloomberg terminal by typing NI space MLIV Pulse. One of the things I thought was interesting is we asked 162 respondents if the Federal Reserve lowers rates under Trump's pressure, what will it do to stocks? And 59% said it will help U.S. stocks outperform global peers. So it looks like this market isn't as concerned about Fed independence. It really would just prefer lower rates, Romaine.
Absolutely. Let's kick things off to the close with Ankur Crawford, Executive Vice President and Portfolio Manager over at Alger. And, of course, this has been the topic all day long and really for the last few weeks as we continue to hear Bahnsen and the other administration officials try to sort of jawbone this idea of a lower rate environment. But does a lower rate environment necessarily mean we should anticipate significant appreciation in risk assets here in the U.S.?
Oh, for sure. As you lower rates, it increases liquidity in the markets, and that will naturally lead to, higher risk-taking behavior. And so, what I do think is that if they are able to, and they will, right? They have told us they're going to yank on the front end of that curve. They're going to pull it down, and it will end up having effects on the market, the housing market. There's been several different markets that have shown signs of malaise for a long time. The transports, housing, the cyclical aspects of our economy should come back to life.
Absolutely, and we should just point out just a few minutes ago, at least based on Bloomberg calculations, we now finally have a full quarter point cut priced in for that September meeting, at least based on Bloomberg estimates here. So a market that's kind of come full circle because we kind of started the year expecting all of these cuts and then everyone dialed that back. But it gets to the point about valuations, and I do want to talk a little bit about the valuations that we're seeing in the tech space, particularly with that AI trade. and whether, 50 basis points or sort of any help from Washington actually makes those valuations look more attractive.
Sure. I think that definitively, as you get lower interest rates, it does support valuations. But I would argue that, the AI trade has actually done beautifully this year. It is basically the only end market that has worked in the market. And could we see a little bit of a handoff over the next few months as AI pauses and the rest of the market kind of catches up? Because the valuation differentials today are quite wide relative to, the economically sensitive stocks versus the secular growth stocks. That doesn't mean that the AI stocks will necessarily go down. It's just they may pause.
Nobody has fatter valuations than Palantir. I was just looking, more than 600 times earnings. It's valued at well over 100 times sales, which is just mind-blowing, right? And this is a software solutions provider. I thought software was dead from this.
I think you're seeing a bifurcation in the market of software that is going to cross the chasm versus software that has to reinvent itself and probably doesn't make it to the other side of this AI technological cycle. Palantir is actually the boat that is saving companies and bringing them across into the AI world versus some of the other enterprise software companies. It is a unique asset with a really incredible, unique technology, which is why when Palantir reports, the stock goes up, and when Monday reports, the stock goes down 30%.
So who are the other ones that survive? I mean, you've pointed out Twilio, MongoDB, Monday as some of the losers. And obviously, if Romain and I can code with AI just as well as any nerd in Silicon Valley, like so many of these companies are unnecessary, but why does a Palantir survive and which other software companies survive?
I think there's a handful of software companies, companies like Cloudflare, which is also a very high valuation. Microsoft, which ends up being a platform to enterprise software, so they're able to harness this cost to create declining and able to create new products. I think a lot of the other enterprise software companies are at risk. I think Twilio could bridge themselves into the new world because they too are an infrastructure type company. But you know what? There's only a handful of companies that we believe will make it.
What do you think about some of the legacy tech companies? We're going to get Cisco earnings later tonight. There's been a lot of talk this year about kind of the reemergence of Oracle, kind of two companies, two stocks that everyone kind of thought were past their prime, and AI is sort of giving them a new lifeline, primarily because they're so mature and, for that matter, experienced in building out digital infrastructure.
I think that we are basically at ground, we have to zero base our thinking, and every company needs to zero base their thinking right now. And the moves that need to be made are not incremental, but dramatic. So if Cisco goes along and, does what they're doing kind of at an incremental pace, I don't think they'll be in that AI winners camp. And what they really need to do is take a great leap forward, maybe acquire assets that place them into a market that is growing rapidly versus, kind of potentially being left behind and their market share being usurped by other businesses that are growing rapidly and addressing the AI market.
I know the AI trade has sort of engulfed this market, has been the most consistent trade, at least in terms of the upside. You did mention cyclicals a little bit. I am curious, if you take AI and really big tech out of the equation, do you find anything attractive out there?
Sure. I mean, we started this conversation talking about some of the cyclicals and the impact of rates and what that will do to our economy. Finding assets like there's a company called QXO, which is a Brad Jacobs company.
Jacobs,
And really,
he's very acquisitive. Have you ever talked to him?
Yes, he is. He's actually, he has a track record of consolidating industries, really driving EBIT margins, and I think it's an underappreciated asset today in that, they've just started on this journey. And if you look historically at what Brad Jacobs does, you want to be an early investor in his businesses. QXO, mostly it's a building products company. He's going to build it as a buildings products company and consolidate this industry, which is highly fragmented. and excited to see what he's going to do.
And that has been his MO, kind of take very fragmented industries, consolidate them. He did that obviously with the supply, with trucking, XPO, and of course, what was it, United Rentals years back, and I'm probably forgetting a few other things. Ankur, we have to leave it there. Great to have you.
Good to see you.
Ankur Crawford is Executive Vice President and Portfolio Manager with Alger, kicking us off to the close here on this Wednesday afternoon. When we come back, we're going to talk about tokenization and digital assets with the CEO of Apex, Peter Hughes, and what it signals about the future of crypto and the blockchain.
Plus, Cava CEO dishes on the future after the company issued a dismal outlook. What will be his recipe for reviving growth in the stock?
And we're going to continue our conversation about the macro, continue our conversation about those comments that Scott Bessent made on Bloomberg TV earlier, a conversation up ahead with former Federal Reserve advisor Andrew Levin. Stick with us. This is The Close on Bloomberg.
A U.S. Treasury repurchase agreement, or repo trade, happened for the first time in recorded history outside of normal market hours through the use of blockchain.
I was actually really fascinated by this. Everyone was talking about this the other day. I mean, this was supposed to be the promise. I mean, you go back several years ago, even before Bitcoin was really all that, and Blythe Masters and all those folks really kind of saying this is what the blockchain can be, not just for speculative crypto traders.
It hasn't really turned out that way, and a lot of things that we thought at the beginning of blockchain technology and the beginning of Bitcoin have been actually the reverse of what they were supposed to be. But it is interesting to see people actually using this for another purpose than just, making money.
Yeah, and I had a chance to catch up with the CEO of Apex a little bit earlier today, Peter Hughes, and this is exactly what he talked about, the idea that the future is here, and it is about tokenization.
It's moving quickly, the space, and it's really quite tough for everyone to stay on top of how fast it's moving and the innovation that's coming through with use of different types of blockchains, both public and private, and how to make sure that they're used in the appropriate way, both for retail and institutions as well.
When we talk about the ability for this to expand, what is the main selling point of expanding tokenization, particularly to real-world assets, rather than just allowing the trades, the purchases, et cetera, to go through the normal process that we've been used to?
Well, I think it allows more people to invest into private markets assets by, I suppose, transforming them into bite sizes where people can actually find them more investable and more liquid. So I'm going to think there's going to be a real transformation where private markets funds and quality assets become available in the wealth channels, the retirement channels, and potentially also the retail channels, as long as the appropriate controls are in place. So it is really, I think, an inflection point for the asset management industry as they evolve and look to get their assets into a wider cross-section of the population.
So when we talk about, and we're talking about assets, at least in this context, that traditionally have been a little bit less liquid and obviously a little bit less accessible to the broader public. So whether it's private assets, whether it's digital assets, or even just maybe facilitating some degree of liquidity in the Treasury market, how much support do you think we will see from the regulators in expanding this, not only here in the U.S., but abroad as well?
Well, I think a lot of regulators are already beginning to get to grips with this and really thinking about how they transform their regulations so that actually the controls are there and the institutionalization of this industry is really happening. So, looking at all regulators, whether, I'm based in Bermuda, which is a very solid regulation around this, but also you think about what's happening in the Middle East, they've got great regulations there, same in APAC, Luxembourg, as well as other parts of Europe. So regulators are already paying a lot of attention to this, as obviously the SEC is in the US. I think as long as the right controls and governance is around and there's room for players like Apex to make sure that there's no money laundering, for example, that if it's on chain, there's actually AML around the different wallets within the chain, that the right controls are in place, then I can really see this transforming how asset management works and really enabling not just quality assets and investments be made available to a broader cross-section, but also how cash and transactions will transform with the use of stablecoins as well.
But do you think we're going to see the more traditional banks getting into this space, if not specifically corporations themselves getting into this space? And conversely, it gets to this idea of when do we start to see governments, major governments and economies also get into that space?
Well, I think so. Certainly, Circle has been leading the way, and obviously that's well publicized. But I do see and hear of corporates using stablecoins to move their internal treasury around already. I'm seeing central banks talking about creating stablecoins to run their finances as well. So it is really moving quickly, and I do hope that the leading banks globally also bring out stablecoins, because I think that is really just a more efficient way of moving treasury around, and the traditional way of actually getting deposits on accounts will transform. And I think certainly I could see a lot of the leading banks thinking about actually how will they bring stablecoins forward, and I think that'll be good for the industry.
You obviously sit in the sweet spot with the way that you've built Apex. I mean, you mentioned earlier, obviously, you're there in Bermuda. You do a lot of business, obviously, across all of the major regions in the world. It's one thing to do a tokenization transaction or a stablecoin transaction from, say, one U.S. customer to another U.S. customer, or one Asian customer to another. But when we start talking about cross-border transactions, you have to address the disparity in regulation from one region, one country to another. How do you do that, Peter?
Yes, we're fortunate. We're in 52 countries with 36 regulatory licenses. So that really enables us to create those rails of global distribution, not doing it jurisdiction by jurisdiction or regulator by regulator. So we're in a strong position to be able to create that global distribution, which I think will be valuable.
How do you view the U.S. market right now in light of the new administration that took power in January, some of the legislation that's been passed, as well as some of the regulatory promises that have been made, and this idea that, particularly in the digital space, for a lot of folks that could not incorporate or set up on U.S. shores, now may have an opportunity to do that in the months and quarters ahead?
Well, I just think what's happened this year has been so positive. I think it was a stop-start piece to the industry. And actually, what's come out of the US really over the last 6 months, has been so valuable, to an industry that was going to happen anyway, and it's just catalyzed the growth of the industry.
Peter Hughes there, the CEO of Apex Group, speaking a little bit earlier today about what's been going on in the digital asset space. When we come back, we turn back to the traditional market and we turn to Amazon. Those shares may actually be primed for more gains as the company expands same-day grocery delivery. Laura Martin joining us after the break. We'll be back in a moment. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Capri. JPMorgan upgrading to overweight, the $24 price target going to $30. And that implies a 12-month upswing of 50% from yesterday's close. And the reason? Pricing power. The analyst specifically cites a fully priced styles over at Capri's Michael Kors brand. Those shares up about 13% on the day to the highest level since March. Next up, on holding. Jefferies, which initiated coverage of the sneaker maker with a hold back in April, downgrading today to underperform, lowering the price target to a street low $40, with the analyst warning of a peak in sales growth, particularly as Nike reinvigorates its business. Those shares down about 3.5%. And finally, backyard grill maker Traeger, burned by a downgrade from B. Riley today, a cut to neutral and a halving of the price target to $150. The analysts still looking for, quote, evidence of sustained top-line recovery as sales suffer. Those shares down about 1.5%, and those are some of our top calls. We do now want to turn to another top story on the day. Shares of Walmart a little bit lower. Shares of Instacart a little bit lower, but Amazon shares, they are higher. And that's because the company finally articulated its long-term grocery strategy, saying customers in more than 1,000 U.S. cities can now order same-day grocery delivery with plans to double that by year end. Laura Martin joins us right now, NeedHam senior internet analyst. And Laura, I mean, this has kind of been a strategy I think they've kind of been hinting at for a while. I can even remember talking to the Whole Foods CEO a couple years ago when they were talking about this. Why now?
It's a good question. Why now? I mean, I think they haven't figured out groceries, and now they've got this huge infrastructure that's sort of done, and now they're going to fill it. I think one reason to go into groceries, it's $1 trillion a year business. So I don't like this this expenditure for Amazon. I don't like the e-commerce business. I think they should be spending money in cloud and advertising and media, all of which have higher returns on capital. But this is going into e-commerce, into the lower margin e-commerce business. So I don't like this decision of Amazon's today.
Well, but Laura, isn't it a reason for people to spend even more of their lives on Amazon? I mean, I have a ShopRite that I attend religiously near me, and if Amazon can offer the same consistency and the same quality of products, I'll spend time there instead of going to my local supermarket.
Yeah, and it probably does drive Prime ownership, because like if you're not paying for Prime today and suddenly you start doing grocery shopping there, suddenly you'll become a new Prime membership person because you're getting more stuff shipped to your house.
But are there people who aren't Prime members? Isn't everyone already a Prime member?
No, there's 144 million households, and there's only, I think, like 150 Prime members. And I don't know about you, but I have 3 Prime members in my house. They're all separate Prime members.
I'm one of those people who's not a Prime member, but I am curious about this, Laura. You mentioned, $1 trillion market. That's great. That's top line, right? I mean, I always thought the grocery business was like notoriously meager when it comes to margins. Why can Amazon, if at all, do better on that front?
I think it's just because they have infrastructure and they're trying to increase the turnover. Like that was Walmart's big innovation, is increasing turns. So grocery definitely turns faster because there's more perishables than stuff like socks and, plates and stuff like that, which is what Amazon normally sells.
Can they benefit at all from AI, something that my local ShopRite doesn't have, and maybe Instacart can't use as well as Amazon?
Maybe. I think that's possible. I think it's more about getting more revenue per person they already have and attracting new people that they don't have yet into that Prime subscription, because they tell us that a Prime subscriber spends like 6 times more than a non-Prime member, which makes sense, right? Because of shipping free. So I think they're just trying to drive their subscription business over in Prime.
I'm just curious. I mean, I'm looking at the negative reaction we've seen in like Walmart, modest, but certainly much more of a reaction in Instacart and some of the food delivery companies. Is this kind of like the beginning of the end for them with Amazon expanding its presence?
I think we have to see whether Amazon is successful. I think they've tried 4 iterations of grocery and they keep failing, and they keep trying something new. So I'm distraught to learn they're going to spend billions of dollars on this iteration. Normally they spend hundreds of millions. So we'll see. If this one doesn't work, those firms will be fine. They're going to throw a lot of money at this.
All right, Laura, great to get your take. NeedHam's senior internet analyst, Laura Martin, talking to us about the Amazon news today. Coming up, Cava shares hitting a record intraday low today after lowering its annual sales outlook. We'll talk about that with the CEO, Brett Schulman, who's still up 200% since the IPO. This is The Close on Bloomberg.
We've been really happy with our results in the quarter and really over the last several quarters and years. And the results, I know it's not always exciting. It is for us in the restaurant industry, but our focus on the customer and the experience that we give them, our employees, and really being consistent with our approach to our strategy is the reason that we continue to win.
The CEO of Potbelly speaking a little bit earlier on open interest with that guy, Matt Miller. I'm Romaine Bostic, and it is 3:30 p.m. here in New York, and this is the countdown to the close.
I'm Matt Miller from Open Interest, filling in today with Romaine, and it's a pleasure to be here. A show that I
would like to say, of all the co-hosts I've had on the show, you're the only one who's been taller than me, by the way.
Yeah, that's probably true. Okay. You've never co-hosted a show with Tom Keene. Because he's like 6'6".
He's gigantic.
Yeah.
He's a giant.
In any case, I normally watch this show, so it's great to be on. He went on, the CEO of Potbelly, to say that the restaurant brand is seeing growth in same-store sales. And for Cava, that's a problem. It can't say the same, or didn't say that today. The shares, you can see, down 15%. However, I would like to clarify that even though the shares are down at the lowest point they've been in a few months, they're still up. They've more than tripled since the IPO. So a bad day for Cava, but it's been an incredible growth story since it went public and before.
And we should point out, despite some of the results, this is a company that is still growing. And pleased to say, joining us here in Studio 2 in New York is the co-founder and CEO of Cava, Brett Schulman. Brett, great to have you.
Thanks for having me.
2.1% comp sales growth. The street was looking for almost triple that, basically about 6%. What happened?
Well, when you zoom out on a 2-year basis, our same restaurant sales actually accelerated from Q1 to Q2. And on a 3-year basis, we grew traffic 20% in the quarter. In the quarter specifically this year, we were lapping very difficult compares, including last year's launch of steak, which was our most significant protein in a number of years, which led to a more pronounced impact on the quarterly results.
When you say impact, that was on the bottom line, though.
No, on the same restaurant
Yeah.
sales. So hurdling that high number.
Yeah.
On the bottom line, on the EBITDA and restaurant level margin, we actually, and EPS, we actually beat estimates.
But I am curious, when you say that it affected, was it that more people weren't coming in because of those offerings, or they didn't feel like that you had the right offerings for them? What?
It was lapping the trial period. Marketing team did a great job. We had tremendous trial.
So
and
it's
then
more about the comparison.
Yeah, more about the comparison.
Gotcha.
I'm looking at the 2-year stacked same-store sales growth on our MODL page here, and I see like eye-popping growth in 2022, 65%. Then in 2023, 35%. Then in 2024, 33%. And now our analysts are estimating 21% for this year and 14% for this year. So you see that trend is coming down. You can't continue to grow at the speed that you were. How do you deal with that as a public company?
Yeah, we've grown our average unit volumes from $2.3 to $3 million over the last few years. So those are very robust numbers. Huge, powerful unit economic model. We're free cash flow positive, funding 18% plus unit growth. So we're building a very robust culinary pipeline to keep that excitement, that newness, and then taking advantage of the massive white space opportunity of new unit growth. We've been growing about 18, 19%, over 400 restaurants now, on our way to our next target of 1,000 restaurants by 2032. So really delivering that powerful growth and unit economic model.
But I'm curious in terms of store openings. I mean, that also was a metric that came in below street expectations. And I am curious, was there any slowdown in the planned rollout heading into that quarter?
We actually raised our guidance for the full year to 68 to 70 restaurants. So we're going to outperform, over-deliver on the unit growth for the year.
When you grow that fast, can you continue to grow the operating margin? This is a metric that continues to get bigger and bigger and bigger every year, right? From basically nothing in 22 and 23 or negative to 4.5% this year, maybe 5% next year, 6% the year after that, according to the estimates I'm looking at. Where do you want to see that number?
Well, that's the power of the brand and the model, right? We keep steady, positive same restaurant sales over the long term. We continue this exceptional unit growth and really start to drive that exponential growth of EBITDA, of net income, and ultimately EPS and free cash flow. You know, we've been driving free cash flow this year, even funding that 18% unit growth. And that's the power of the economic model, while we, at the same time, we're bringing our Mediterranean cuisine to communities across the country.
There has been some debate as of late about just the business model of the type of fast casual, or I don't know how you want to categorize it. We had earnings out of Sweet Green, which has a kind of a similar business model to Cava. They're having some issues, and it's more about just the foot traffic, not necessarily just about costs and inputs and things like that, but the idea that maybe the price points are too high, or people have just moved on to other types of ways to feed themselves. What are you seeing?
Yeah, we're not seeing anything underneath structurally in the business. If anything, we're seeing greater structural strength. So when you think about how much we've grown over in recent years, you think about how we've been able to drive our value proposition. So in recent years, we've now underpriced CPI by 900 basis points. So again, our value scores continue to improve. We continue to make our food more accessible and really try and mitigate any of the impacts of, say, tariffs and not have to pass along to our guests. So in January, we only took 1.7 incremental menu price adjustment, and we have no plans to take further price for the rest of the year. So continue to drive that overall value. And, you know, when you look at our day part mix, right, we've got 50% lunch, 50% dinner, roughly. We work in the suburbs, we work in the city. We cook with fire, we roast, we grill, we braise. So people can come to us for dinner, they can get a great meal for lunch. And then with our channel mix, we have 65% in restaurant, 35% digital. So people are accessing us for a quick digital order lunch, or to sit down in the suburbs on a Wednesday night to have a great family dinner.
You said 1.7 though on the take, and I am curious. Does that mean that and you expect that not to increase? Does that mean you don't expect any material increase in your costs and the cost of the ingredients or the cost of labor?
Well, that's a credit to our team, right? We're working to be more efficient and offset and mitigate that. Our restaurant level margin came in above expectations at 26.3%. So outstanding unit economics, where we didn't have to pass along any of those impacts we're seeing from tariffs because we're able to offset it in other areas of the business.
I was talking with our lovely producer, Finley, while we were looking at your website, and she saw that little PETA keychain toy, and she said, I have to have one of those. And I actually talked to somebody on the desk over here, Bridget. She also said that they're really a hot trend. What's the story with that?
Well, I've got a couple Peter Chip plushies here with me that we can give to her after the take. But, you know, it's a way for us to, again, build emotional connection. We launched Peter Chip on National PETA Day, and plushies are certainly hot, you know, the Labubu craze. And it's a way for people to really connect with the brand and have a unique way to take a bit of Cava home.
One of the other things I learned from Bridget over here is that her sister is thinking about going to a Cava near like a big successful bank and grabbing somebody else's order so that guy calls her later. Have you heard of this sort of meet cute scenario?
I have seen this. I have read about it, especially in the city. And, you know, I think Cava is a great place to meet someone. And that's what we're about. Human connection. That's why we're investing in our dining rooms. We've got Project Soul to really enhance our experience in the dining room. So it's a place you want to come down, share a meal, or maybe meet a significant other.
That's key. You don't want to just be like a salad conveyor belt.
No.
You want to have a place where people want to hang out, and occasionally, if they're not going to go back to the office, sit down and eat lunch.
Well, I am curious about that point, though, because there's been a lot of talk about how do you reimagine stores like this. Of course, Starbucks, which kind of moved to kind of a takeout model, is now sort of dialing that back and saying we want to be a place where people come and linger and sit. What do you want your customer to do?
Yeah, we don't think it's an either or. We think it's an and. If you're in a hurry, we've got great digital channels. We've got 60 drive-through pickup windows. But if you want a great physical experience, you can have that walk the line experience, see the food, smell the food, interact with our team members. Part of our brand essence is our Mediterranean hospitality. Our mission is to bring heart, health, and humanity to food. So we want to deliver that humanity in the four walls of our restaurants and have a great environment for you to enjoy your Mediterranean meal.
And maybe meet the love of your life.
Yeah,
that's right. There you go.
Over some hummus.
Making some connections there. Brett, thanks so much for coming. Really appreciate it. Brett Schulman there, Cava, co-founder and CEO. Now coming up, global crypto exchange Bullish went public today at billion-dollar IPO as our stock of the hour. Next, this is The Close on Bloomberg. Today's stock of the hour is Bullish. It's a cryptocurrency exchange making its public market debut and surging on its first day of trading after pricing at $37 a share. Let's bring in Bloomberg's Bailey Lipschultz to find out how much they raised, how much they're worth, and what they're doing.
The company raised more than $1.1 billion at that IPO price, was something like $5.4 billion. When the stock essentially doubles, you can go ahead and double that market cap. So call it $11 billion in market cap. This is another company that we're seeing in the crypto space riding this IPO momentum. Circle, obviously, up triple digits, as well as some of those other companies.
What's unique about Bullish? I mean, when I look at a publicly traded crypto exchange, obviously I immediately think of Coinbase, maybe Circle. What does Bullish bring into the table?
Their pitch is the institutional side. So they're focusing on helping build out the infrastructure, the exchanges, as it focuses to institutions, real wealth managers. They also happen to have a few billion in Bitcoin, though when I talk to the CEO, they don't plan on becoming a quote-unquote treasury company.
Not now.
Not now.
Yeah.
But that's another thing that investors are kind of giving them credit for, as we see the likes of Strategy trading well above the amount of Bitcoin they actually own.
What is the deal with this? Used to happen all the time, where you'd go public and immediately double and triple the value of your shares. And then I think some investors realized they were leaving a ton of money on the table. It seems to be now almost a meme-ish thing that's happening again. Do the investors care?
Investors are winning. If you're buying the IPO and you flip it at 100%, you just doubled your money without any real risk. You look at kind of the longer term investors. There are two camps. You want to squeeze every penny from this IPO, price it as high as possible.
I feel like my banker didn't really do his job if I'm losing, half of what I could have made.
With these companies, though, those CEOs are in these meetings. So they know full well what this is pricing at, where the demand is. The pitch is also you want to maintain the relationships with the ARCs, with the BlackRocks.
Every time there's an IPO, I sit right on the other side of this, and I get to listen to Matt's show in the morning and hear him rail about all the money left on the table. But I am curious about valuation here. Right now, at least based on the trading today, it looks like it's going to close out at around $10 billion valuation. Coinbase is at like $80 billion. Circle $30, $40 billion. Is there a case to be made that a $10 billion valuation, to Matt's point, might actually be low?
Well, they wanted to go public via SPAC, I want to say around 9, north of 9 a few years ago. And you could argue, if you look at a number of these crypto companies, they've only grown since 2021. So you could argue that if this is going to be the future of finance, if this is a 2-decade thing that the entire world of Wall Street is going to go on the blockchain, there could be a potential argument to be made that that makes sense. Seemingly people are buying it. Is it a day trade? I don't know, but it certainly is capturing investors' imaginations. And when you're getting priced at above range and you're raising your marketed range and you're seeing some of this demand, investors want to put money to work.
Talk to me about the CEO. Tom Farley was at the New York Stock Exchange today, and it wasn't his first time there.
No.
Because he used to be the president of the New York Stock Exchange.
Yeah, had left the company. He was in the SPAC game, was trying to take bullish public via SPAC a few years ago, had since obviously left the company and gone to bullish and really leading that company. The interesting thing is we're seeing in kind of your traditional Wall Street further embracing crypto, further embracing AI. He's another example of what was once a shining star as it relates to the New York Stock Exchange, now leading a company and at least at the forefront of driving the conversation further for cryptocurrencies.
Yeah, you would think, given his affiliation with the NYSE, they settled on the ticker BLSH. I know BULL was already taken, but couldn't he have, pulled some strings there and got that out?
Well, they normally are. They normally lock up their tickers ahead of time.
Yeah.
So.
All right. Well, that's okay. All right. Bailey Lipschultz there. A closer look at the newest entrance to the public market that is bullish. Of course, they sold the IPO yesterday at $37 a share. It opened today at $90. Now trading at $71 and change, up almost double from the IPO price. When we come back, Jordan Jackson over at JPMorgan Asset Management counts us down to the close.
As you get lower interest rates, it does support valuations. But I would argue that, the AI trade has actually done beautifully this year. It is basically the only end market that has worked in the market. And could we see a little bit of a handoff over the next few months as AI pauses and the rest of the market kind of catches up?
And the AI trade has done beautifully. It's a big reason why you see the S&P and the NASDAQ holding around record highs. However, Ankur Crawford there over at Alger, she pointed something else out when we talked to her earlier today, and that's about the cyclical trade. The Dow Jones Industrial Average actually less than a half percentage point away from getting to a record high itself.
Yeah, and a much bigger jump on the Dow today than on the S&P. It's currently up. The old smaller one up 1%. The S&P only up 0.25%. But it is the AI play that's pulling that index higher. The biggest leaders on the Dow in terms of point additions are Apple and Amazon. We have news out that Apple's going to make some kind of humanoid robot in the distant future, and Amazon is going to deliver all your groceries.
The near future, 2027.
2027 seems very far away.
We'll see if they actually meet that, though. Too, also keeping an eye on some of the individual movers. We do get earnings after the bell from Cisco, but keep an eye on Paramount Skydance, PSKY, which of course just started trading last week after they closed that deal under David Ellison. Those shares up today almost 40%. Remember that we had a big sell-off the first 2 days of trading. They rebounded yesterday, and now apparently this has to do with maybe some more commentary from the company about its plans for what it plans to do. It's holding a press briefing and says David Ellison saying they plan to, quote, significantly boost streaming content and boost film production to 15 to 20 annually per year.
Yeah, adding $4 or $5 billion to their market cap, now trading at about a $17 billion market cap. Paramount Skydance, a company that's going to definitely be using that money for acquisitions.
As we continue to count you down to the closing bell, it's just about 8 minutes away. We turn back to the broader market and take a closer look at what's actually driving it and, well, quite frankly, whether those gains can continue. Jordan Jackson joins us right now, global market strategist at JPMorgan Asset Management. And Jordan, I don't think it's any real secret right now. This is a market that, at least for right now, the bulls certainly have control over. And I am curious if you see anything on the horizon that would see them loosen their grip.
It's tough. Obviously, a breakdown in trade negotiations, a flare-up again of geopolitical risks, all could create a little bit of a wobble here. But as you mentioned, the bulls really do have control of the narrative. And when you look at some of the reasons for that, one, there appears to be really somewhat of a softer tone in terms of trade. When you look at, extending of the trade negotiations with China, ongoing negotiations with the U.S., Japan. We're no longer worried about 200% tariff rates on pharmaceuticals, as well as lower tariff rates potentially on semis. So on balance, the trade rhetoric is softening a bit. And importantly, we're yet to really see it meaningfully impact the inflation numbers. Now, we expect that to happen, but I think the markets are banking on it not feeding through significantly through some of the inflation prints. And then lastly, Powell has the opportunity to strike a bit more of a dovish tone at Jackson Hole on Friday. Now, I don't think he's going to open the door for 50, but I think he's going to mention that September is certainly a live meeting.
I am curious, though, and we heard that earlier today from Austin Goolsbee, and I think that's kind of the market already kind of knew that. But when you hear the commentary from White House officials, including Scott Bessent, who was on this network earlier today, talking about the idea not so much of just a rate cut in September, but the idea of the start of a prolonged dovish cycle for monetary policy. And I am curious, Jordan, in your view, when you look at the economic data and you look at the health of corporate America and the markets, do you see justification for a long-term dovish tilt in monetary policy?
Well, I think we could certainly expect cuts through at least the middle of next year, depending on how quickly the Fed can get to a number of low 3% range. Let's call it 3 to 3.25. Now, markets expect the Fed to get there by the end of the year. They could get there a little bit sooner than that, but you've got to be really wary of the stagflationary tilt to the data that we would expect to start to see over the next couple of months. Obviously, we do get another employment and inflation report before the September meeting, which are going to be very, very important. I wouldn't be surprised if you start to see hiring come back online a little bit. So kind of reversing a lot of the downward revisions that we've seen to the payroll numbers over the last couple of months. And we still do anticipate you are going to start to see some inflationary pressures as well. And I think both of those dynamics could tamper Fed expectations. I'm still in the 2-rate cut camp this year. Clearly, the markets are shifting a bit more dovish than that.
Yeah, I spoke with former St. Louis Fed President Jim Bullard this morning, and he said he expects maybe 75 basis points this year, but not front-loaded, not 50 basis points right away, because that would signal a little bit of panic, and he doesn't think the economy warrants it or that the Fed is going to do that. I wonder what kind of tone we're going to get, though, out of Jerome Powell on Friday. The big event, obviously, is the Alaska meeting between President Trump and President Putin, but for markets, Jackson Hole is what it's all about.
That's absolutely right. Matt, Jerome Powell can really set the stage and tee up that rate cut. I think he's going to. He's done a great job of adopting a bit of a bedside manner, and so I think he won't overreact and lean too much. He's certainly going to mention we've got 2 more very important reports. But I do think the softening that we've seen, particularly in the labor market, and if you look at in the second quarter GDP numbers, right, removing the volatile exports and inventories and really just look at real final sales to private domestic purchasers, again, that's slowing over the last 6 months to about a 1.5% run rate relative to the 3% that we saw in 2024. So this is clearly an economy that's slowing. You do have to be patient in terms of what inflation is going to do. But I think we're talking about a Fed being able to ease up on restrictive, right? Rate cuts are not going to be stimulative, but they can allow for a less restriction on the economy, which I think is an important nuance to highlight.
Jordan, we saw, if you look at the EEG screen on the S&P for earnings, huge dive and then a jump for expectations in Q1 and Q2. But Q3 doesn't look like that. It just sort of flattens out here. What do you expect from corporate America in the next, quarter or two?
Yeah, I think we're going to continue to hear a bit of the same message that the consumer is okay. We actually have started to see credit conditions continue to improve, loan activity starting to pick up a little bit, which I think is going to be supportive on a go-forward basis. But I think, coming into the year, markets were expecting, call it 14 to 15% earnings growth. The numbers right now back down to around 10%. We could be looking at a weaker third followed by a decent bounce back in the fourth quarter. But I think really what the markets care about is what's going to play out in 2026. Clearly, corporate America are sitting on particularly mega cap tech. They're sitting on good profit margins. They're likely going to be able to absorb a good amount of these cost pressures. But as we look at towards 2026, some modest fiscal boosting consumers, the big beautiful bill helping to help deduction and expensing for domestic R&D. Now you're looking at a bit of a consumer and corporate boost to spending in the first half of next year.
Hey, Jordan, we got to leave it there. Up against, of course, the big simulcast coming up now as Jordan Jackson helps us count you down to the closing bells. A full breakdown of all of today's market action. That breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the closing bells. Romain Bostic here alongside Matt Miller, counting you down to the closing bells. It's with the global simulcast, and it starts right now. Carol Massar joining us from the radio booth. Tim Sinovic is there for the first time, I think, in a couple of days. Welcome to our audiences across all of our Bloomberg platforms here on Bloomberg Television Radio, our partnership with YouTube, a broad-based rally that has taken stocks to yet another record high. Carol Massar.
Yeah, I know. All in, it feels like. What could go wrong, possibly, in this environment? I mean, it seems like investors at this point, we had a red headline cross the Bloomberg a little while ago about traders, investors pricing in a full percentage, not a full percentage point, 100% chance of rate cut come September. I would just caution again that there's a lot before we get to that Fed meeting and decision.
There's also a lot of questions about data and what data we're actually going to get between now and then. Certainly we'll hear from the Fed chair in Jackson Hole, and we'll get a better idea of what he and maybe other Fed speakers are thinking. But yeah, that meeting in September, I think it's fair to say it's a live one.
Yeah, well, I mean, it seems like the market is just happy that the president is pushing down rate expectations, because we had an MLive Pulse survey that showed 59% of respondents were happy that the president was trying to talk down rates and said that the stock market was going to benefit from that. We're headed to 6,500 on the S&P and possibly 50,000 on the Dow Jones Industrial Average.
This is a pretty broad-based rally. About 85% of the stocks in the S&P 500 are in the green on this Wednesday afternoon as we get the closing bells here in New York. An S&P 500 up about 20 points or 0.3%. And yeah, that's good enough for a record high. We're going to wait for these numbers to settle just a bit, but it looks like the NASDAQ Composite and the NASDAQ 100, which are straddling the line between gains and losses, are going to finish the day in the green, also at record highs, at least for the NASDAQ 100. The Dow Jones Industrial Average up about 1% on the day, and we should point out it is less than a half a percentage point away from reclaiming its record high, a record high that goes all the way back to last year, so a bit of a laggard. And the Russell 2000 also trying to catch up. A gain today of roughly about 45 points or 2%, and that now puts it about 5% away from its record high that it last saw back in 2021.
Yeah, feels like some exuberance in this market, no doubt about it. Back to the big caps we go, and yeah, fairly broad-based in terms of the buying. Matt, you've got about 418 names to the upside in the S&P 500, 85 losing ground today.
I just want to point out that Bitcoin is also at an all-time high. As we're celebrating all-time highs, $122,840 is a Bitcoin. Here's your IMAP to see which sectors did well and which did poorly. Tech is down, and actually NVIDIA closed the day lower, but we had Apple and Amazon adding the most points to the S&P 500. You see financials did well, industrials did well, and healthcare as well, and that's why the Dow Jones outperformed the S&P 500.
All right, folks, let's get to some of the individual gainers, if we may, in today's session. Number one gainer in the S&P 500, Paramount, Skydance soaring up as much as 60% or almost 60% at its highs today, intraday, finishing with a gain of just shy of 37%. Exuberance, excitement, I don't know. You know that Paramount and Skydance, of course, completed its merger last Thursday. On Monday, it announced a 7-year agreement with TKO Group, giving Paramount exclusive media rights to UFC events in the United States. All I'm going to say is investors just continuing to push this one higher and higher and higher. Warner Brothers, also some outperformance today, up about 7.5%. Top gainer in the S&P 500 and the NASDAQ 100. Some insider buying. A director, Anthony Levy, reported a series of insider stock transactions to the SEC. Stock is still down about 11% since the end of July, but it is up about 15% year to date. Here's something different, ticker WBTN. We're talking about Webtoon Entertainment.
Yes. Can I just tell you, I saw this route yesterday, the big move, and I didn't know it was a public company.
It is a public company. It's also 81% higher in today's session, jumping by a record today. Stock is up the most since its IPO. It is now a roughly $2.1 billion market cap company. It's based in LA. It's a storytelling tech platform. And the news today, a Disney partnership to launch 100 comics on its platform. And the company reported earnings. I know, right?
Big deal in my household. Yeah, I never knew it was a public company.
You're watching cartoons?
I have children.
I think the kids,
Carol,
and I don't mean
children?
young kids, right? I think that we had teenagers in our editorial meeting a few months ago telling us they love webtoons. So it's a thing that they do.
Yeah, I mean, you don't have to be judgmental.
It's a bullish.
Was Romaine one of the teenagers?
Adults can watch cartoons too.
It's definitely I know. It's definitely a bullish thing. And speaking of bullish, I got to just bring this up. I wasn't sure that this would be a gainer. IPO today.
Wait, you weren't sure it was going to be a gainer? What were you waiting on, for it to drop from 84% gain
tripled at the open
to flip to negative?
It kind of bounced. All right. It kind of bounced around. Be kind.
Between 145%,
we're looking at the intraday chart right next to your face there.
Hey,
the ticker is BLSH. It's kind of a clever ticker. It is up about 89% in its first day of trading. Can I throw one more in there?
Sure. Don't look at me to ask.
UAMY. If you haven't checked out this ticker, it's U.S. Antimony. We had the CEO. It's not rare earth minerals, but it's all about a specific mineral that's used in bullets and defense. And we had the CEO on, and the stock is up about 5%. And I think clearly say it's as a result of our interview. So check out the interview online.
All right, I'm going to go with...
I'm done.
I want to start with NVIDIA on the decliner side, down 0.9%. We did see semis and power generation stocks that were linked to the AI boom selling off today. This after CoreWeave gave a disappointing earnings outlook that reflected costs of rapid data center expansion. NVIDIA fell as much as 2.1%. It did close at a record yesterday, $183.16.
Even with the export tax.
Was that all-time high. I want to talk CoreWeave, down 21% today. The company reported a wider quarterly loss. It gave a disappointing earnings outlook. It raised concerns about its rapid AI data center expansion, putting some pressure on profit margins. The company's CEO said, quote, "We are scaling rapidly as we look to meet the unprecedented demand for AI." The company said it's spending on acquisitions and new capacity. And finally, Cava, down 16.6%. The company shares fell after it trimmed its annual sales guidance and cited slower quarterly sales growth. I saw Brett Schulman on your air. We're going to have to put that on hold, though, because we're getting some earnings.
Yeah, Cisco, remember them? They're actually out with their earnings right now. We're going to start first with the most recent quarter, the fiscal fourth quarter. Revenue did come in relatively in line with estimates at about $14.67 billion. On the EPS side, it also looks like a modest beat, 99 cents versus 98. But here's your forecast going forward. The company says for the full fiscal year, which basically started at the start of this month, adjusted EPS will be in a range of 4 to 406. The street was looking for 403. So a tight range that pretty much straddles the line of what the street was looking for. And the revenue guidance, the company says that for revenue for the full year, $59 to $60 billion. Again, tight guidance here. The street was looking for 59.49. You see the reaction there in the shares here, down about 3%. And maybe this is the idea that for a company that was supposed to finally be nudging its way into the AI ecosystem, maybe investors were looking for maybe a little bit more upside on the guidance.
The gross margin, 65.7% GAAP, non-GAAP, 68.4%. Just incredible margins. But keep in mind, this was the poster child for overspending to build out infrastructure during the dot-com bubble, right? And we're looking at other companies showing signs of that today, like CoreWeave, right? So it's interesting to see Cisco come out and post this kind of growth, this kind of gross margins. You wonder if they can keep it going on. The CEO saying that it was a strong close to the fiscal year, that in the fiscal year here, driven by accelerated innovation and solid execution. AI infrastructure orders signal massive opportunity ahead, according to Robbins.
And they do say in the release that their AI infrastructure from web scale clients, so basically those hyperscalers, that was over 800 million. Should also point out, you were mentioning the CEO's comments in the press statement. Chuck Robbins, he is scheduled to be on Bloomberg Television tomorrow during Bloomberg Tech.
All right, looking forward to that. I mean, the stock has definitely been moving up this year on expectations that it would definitely be able to play into the AI impact that we've seen on so many different companies. Chuck Robbins, though, also moving into the services area, and service revenue, $3.79 billion versus $3.78 billion year over year. The estimate was $386, so a little shy of what the street was expecting. Again, they've been trying to kind of, I don't know, modernize their model, move into other areas. And so maybe it's just not a straight move forward for this company, because you definitely see some disappointment by investors, down about 3% here in the aftermarket. Again, though, it's been moving up this year to date.
Yeah, go ahead.
I was going to say a lot of questions on that. We're going to dive deeper into those fiscal earnings on the television side. And I just want to point out, ticker COHR, Coherent, which also operates in this space, those shares down 14% right now. Apparently some disappointment in its guidance as well.
Yeah, Woo Jin Ho is going to be joining us in just a few minutes, too, from the Bloomberg Intelligence team. We're going to be diving deeper into these Cisco earnings. Worth noting, once again, the AI infrastructure orders that the company got from web-scale customers in fiscal 2025, that was more than double Cisco's original target. Still, investors not so happy with the results.
Yeah, right through right now by Dina Bass and Brody Ford. Cisco giving a lukewarm outlook with investors craving that AI boost. So some writing through on that earnings release. All right, folks. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Catch the Cisco CEO live on Bloomberg Television tomorrow morning, and continue watching with Romaine and Matt, of course, on Bloomberg TV. And Tim and I are going to continue on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
We're going to let Matt get home, take a nap as he has to get ready for open interest tomorrow at 9 a.m. Meanwhile, the close does continue on here with a fuller breakdown of those results out of Cisco and, of course, the broader AI infrastructure and the questions around it. This is the close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Welcome back to the close. You take a look at the dollar, which continued its weak streak over the last few days on a day where we saw volatility tamp down in the FX space, in the bond market, and in equities as well. The VIX right now at its lowest levels going back to December, and you see the move in the two-year yields continuing to drop lower, down about 5 basis points. A lot of folks are now starting to make big bets when it comes to rate cuts. It's a big part of the reason why you saw the differential on the first two lines of your screen. Outperformance for a third straight day by the Russell 2000 relative to its large cap brethren. And that could be a big part of the story going forward, a re-embrace of some of the cyclical and economically sensitive stocks, and maybe a little bit less on the big cap and speculative. At least for today, though, there was still a trade in that space. You see that reflected in Coinbase, a 1% move higher on a day where we did see Bitcoin trade at yet another record high. Hasbro on an 8-day run right now, up 3% here on the day, largely because of optimism around tariffs. Remember, a company really tied to the China supply chain ecosystem, if you will, but that 90-day reprieve that Trump announced just a couple of days ago, giving investors a little confidence that Hasbro can not only navigate the here and now, but of course the holiday season as well. But there are two big stories in this market that are kind of to the downside. CoreWeave there, 21% drop on the day. A lot of concern right now about the build out of AI infrastructure, just how much that spending is, and more importantly, what is the ROI? And that actually brings us to our top story. And then it involves that trade, and it specifically, at least for right now, involves Cisco Systems. Cisco, of course, was one of the first companies to sell dedicated network equipment to connect computers decades ago. It was a market darling, sort of the NVIDIA, if you will, of the computer revolution of the 1980s. It was the fastest company to reach $100 billion market cap. Its stock at one point tripled over a 12-month stretch in 99 and in 2000 to leapfrog past Microsoft and make it the world's most valuable company. But by 2002, the party was pretty much over. For that new economy hero, its market cap plunged to a tenth of what it used to be, and a lot of people just forgot about it. But perhaps in a nod to the idea that everything is cyclical, Cisco is back in vogue. That stock prior to today rallied 30% over the past 2 months on optimism that Cisco's old school, secure computer networking portfolio was a perfect fit for the new AI infrastructure boom. Organic growth combined with last year's acquisition of Splunk reignited Cisco's revenue growth. And that company just reported results for the fiscal fourth quarter. And that growth is still there. Revenue up about 7.6% in the most recent quarter to about $15 billion. But the company said the money it's making directly from AI That was about $800 million. That's double what the street was looking for, but nowhere near the big growth story that I think some investors would like to see, specifically on the AI front. And that's where we're going to spend some time now. David Bahnsen joins us right now. He's the Chief Investment Officer over at the Bahnsen Group and has been a longtime holder of Cisco. The results just came out. They were not bad by any stretch of the imagination, but you did not necessarily see those eye-popping sort of figures that you're getting from other companies. We're going to spend X $100 billion on this, or we're going to have, double-digit growth rates there. This is still kind of a slow and steady company, and I'm wondering if you're satisfied with that.
Yeah, I would be unsatisfied if it weren't that. And I mean this very seriously. Easy come, easy go. You're seeing it with CoreWeave, right now. These big violent moves up and down are problematic for dividend growth investors like us. Cisco does have a call option on AI. They have a future growth play that they're very well positioned for, but it isn't something that should be creating a 20% move on the result of one quarterly announcement. Now, to your point, they're up 25% over the last several months, and that's why you see a very slight sell-off here today. They beat on top line, they beat on bottom line, and they didn't adjust forward guidance either. They actually increased modestly the bottom end of that range. The issue is that it's trading at 15 times next year's earnings. The other companies you're talking about are trading at 50, 60, 70 times next year's earnings. And so Cisco clearly is not being looked at by the market as that type of major quick growth story. 800 million, $1 billion in AI, that's just fine by us.
Yeah, and it's kind of interesting you bring up those multiples. I mean, obviously, when you put them up against some of those names you said, but even some of the more pedestrian names like, Broadcom and HPE, we're talking about multiples that are way higher than what we see with Cisco. What do you want to hear, though, from Chuck Robbins? I mean, I think everyone knows that he has done a relatively good job in trying to steer this company into the new future. But now you're at this critical stage where everyone wants to see more. What do you want to hear from him?
Well, I want to hear that they're continuing to grow the percentage of their business that's coming from recurring revenue. I think that's the future. You've seen IBM be incredibly successful in a lot of that transition. And essentially, Cisco has a great business with those old school businesses that we talked about. That networking equipment, that hardware, it's come down to about 48% of business. I like the fact that recurring services are now at this point about 38% of business. When we first invested, it was barely 20%. That gives you a better multiple. It gives you a better foundation of recurring cash flows. That's how Cisco's been able to grow the dividend at over 7% per year for a decade. So this is not a new tech company. They're old tech that is doing a lot of new tech things. That's a great combination for investors like us.
We were talking to a guest earlier today, and she was kind of talking about what she wanted to see out of Cisco longer term. And there was a discussion there about acquisitions. And I am curious, as an investor in this, would you be comfortable with Chuck maybe taking a more acquisitive approach to growth rather than just organic?
Well, first of all, when Cisco's stock was at the ridiculous levels in 1999, they acquired a lot of companies, which is the reason they lived to fight another day. When the stock dropped to 90%, they had used their expensive currency to acquire a lot, and then they grew wonderfully for 20 years. They just simply had a stock price that had to repair from bubble bursting. The Splunk acquisition was $28 billion. So that's a very acquisitive, transaction, and on the high end of what I would ever want them to spend. The Duo acquisition, I believe, was only $4 billion. They've got a really good position in cybersecurity. So yes, I like using M&A, but they have to do it diligently. I wish everybody would do deals diligently. Some companies don't have to think about that because their stock price is so expensive. They're just using a really high currency to go acquire. Cisco has to be very cash flow accretive to make deals work.
When we talk about, and I'm glad you brought up the Splunk, because there's been some people that are saying that when you look at the results that we've gotten over the last couple of quarters, and more importantly, the guidance going forward, that a lot of that has to do with Splunk, not necessarily just in terms of one for one, we're going in, but the idea that it added a security bona fides and some other things that Splunk was able to bring to the table that makes the ultimate Cisco product, I guess, as a package, a little bit more attractive.
There's no question about it. That, look, as much as I love their old school businesses that have very high free cash flow productivity, Cisco would be trading at 9 times earnings if all they were was selling routers. The multiple that they have that has come up higher is a result of the Splunk acquisition, that hybrid cloud AI play coming together. Look, I was concerned with what IBM paid for Red Hat. I was concerned with what Cisco paid for Splunk. They validated those M&A transactions. They become very successful for the growth trajectory of the business.
Is there sort of a role in that broader AI ecosystem where you can see Cisco maybe getting a little bit more of the hype that goes along to, whoever the CoreWeaves or NVIDIAs or whoever else, if you will? I know you're kind of poo-pooing that. I know you're more of a value dividend guy, but that hype, it helps sometimes, right, David?
Well, it could also help us to get paid 5 years worth of return in 1 year and end up having to exit the position. I mean, it could happen, and everybody would be very happy if it did. It's not what their business fundamental is. It's not what their business culture is. But it's entirely possible that they're basically showing up at the right dances, and then you could end up with a very good situation. So yes, that's why I refer to it as a call option. It's not priced into the stock, but there is that opportunity for that asymmetrical upside. But what they have to do is block and tackle, because it is a value-oriented company. You're not trading at 15 times earnings if people expect you to become the next NVIDIA. What they are doing is exactly what they should be doing, with some asymmetrical opportunities to the upside.
All right, David, got to leave it there. David Bahnsen, the CIO there over at the private wealth management company, the Bahnsen Group, and a holder of Cisco. We should point out that conference call is scheduled to start in about 10 minutes' time. You'll get a chance to hear from the CEO, Chuck Robbins, there. But if you miss him, you can catch him tomorrow right here on Bloomberg Television at 11 a.m. Eastern Time on Bloomberg Technology. All right, when we come back, we're going to continue our conversation about what's going on in the tech space, what's going on with AI, and what's going on with Apple. Apparently, there is a strategy. We're going to talk to Mark Gurman, and he's going to share what that strategy might be. That's coming up next here on The Close. This is Bloomberg. All right, let's talk Apple. Of course, one of the big laggards in the big tech space, but it has quietly added about 15% in market value just over the last few sessions, including closing higher once again on the day. Some of this tied to the idea of a potential plot on an AI comeback. The company's strategy hinging on a slate of new devices, including a robotic arm, a lifelike version of Siri, and a smart speaker with home security cameras. Mark Gurman broke that story for us earlier here on the Bloomberg Terminal. He is our managing editor for consumer technology. All right, let's start with the one everyone's talking about. What is this robot going to look like, Mark?
Yeah, thank you so much for having me. So, robots, that's Apple's next big initiative. It's something they started working on as part of the self-driving car project many years ago. And if you think about it, a self-driving car is really a robot. It's something that moves, it has wheels, it has sensors to understand the environment it's roaming in. And if you think about it, a home robot is a much smaller scale, much safer, less regulated self-driving car. And so their first robotic product is going to be an iPad on a moving arm. And so this iPad on that arm can be on your desk, can be on your kitchen counter, can be in your living room. And as you walk around a room, it can follow you. You can also use your iPhone touchscreen as a joystick to move the camera on the display around to follow you if you're on a FaceTime call. It could also summon you, or if you're talking, it can move to look at you. And so it's an in-space tabletop robot. They're also working on a manufacturing robot and a robotic arm that can be used for manipulating inventory in the back of Apple retail stores, but that's several years away. They've also explored mobile robots with wheels that can roam through your house. And the other thing that they've loosely discussed are humanoids, which obviously Elon Musk and other companies are actively working on.
So I am curious about this idea of how far away they are from this. I think your story mentioned the robot maybe 2027, but you mentioned the Apple car, Mark. I think every time you used to come on this program, I used to ask when that's coming out. Is this one of those products and initiatives that we'll hear a lot about, but we'll never actually see that product in an Apple store?
No, this is going to come to market in all likelihood. The stakes are much smaller scale than the car. The economics are much different than the car. The operational know-how, the amount of people that need to be involved in this. I mean, building a car is a 10, 15-year effort that changes the whole course of history for a company. And they had a clear move forward or not moment a couple of years ago and decided not to move forward after burning all that capital. Robotics in the home, robotics in manufacturing, this is where AI in the industry is going. It's not an apples to apples comparison at all, I think.
And I'm just curious about the manufacturing side of making these things here. Did they articulate or did you get any sort of sense in your reporting of where these things will be made, what that kind of supply chain will look like? Is this going to be something homegrown here in America?
I mean, Apple doesn't make products in America, despite what the company wants you to believe, what Donald Trump wants us to believe. Apple makes its products in Asia, right? They source some components in the United States. They design their products in the United States. They do their R&D in the United States. Apple products are built in Asia, and that's not changing anytime soon.
All right, Mark Gurman, our managing editor for consumer technology. A great scoop right now on the Bloomberg terminal about Apple's AI ambitions and how they may actually be taking the form of hardware, specifically with robots, a smart speaker, and a home security camera. All right, when we come up, we're going to talk about executive compensation. All those multi-billion-dollar pay packages in some cases. And we're going to see, well, whether there's actually any real rationale behind them. Gautam Mukunda going to be joining us from the Yale School of Management when we come back after the break. This is The Close on Bloomberg. Time now for our top three, where we name drop the people driving some of the day's most talked about stories. And we start off with Rick Reeder. BlackRock's CIO of Global Fixed Income is apparently up for Fed chair consideration. That's according to reporting by Bloomberg, and it also includes some other names in there as well, including David Zervos over at Jefferies. Next up, Nick Hyatt, the Swatch CEO, watches, saying that the Swiss government should actually counter U.S. tariffs with a gold levy. Of course, the Swiss, a big producer of gold, both the raw and finished product. And we run around out the top three today with Lisa Su. In her interview with Wired magazine, the CEO of AMD said that she is not going to use the same playbook as Meta's Mark Zuckerberg with regards to those outsized pay packages that we've seen to recruit AI talent. Of course, AMD, or Lisa Su, I should say, one of the higher paid CEOs out there. And that actually brings us to a great column that we had on the Bloomberg terminal earlier today from Gautam Mukunda. He's a lecturer over at the Yale School of Management, who says that these incentives, specifically for the CEO, actually encourages behaviors that are bad for companies and shareholders. Pleased to say that Gautam joins us right now to talk a little bit more about this. And some of these numbers are eye-popping. Obviously, Tesla's and Elon Musk pay package, which I think is now ratcheted down to just a mere $29 billion, has sort of been emblematic of that. But it's also Hock Tan over at Broadcom making a couple $1 billion, if you will, assuming that those incentives come through. And even David Zaslav, who found a way to pay himself several hundred millions of dollars. Why are these pay packages even being approved in the first place?
So there are two reasons, right? The official reason is boards have been convinced by their CEOs that these people are totally critical and they have to be paid these astronomical sort of founder entrepreneur type sums or they'll just walk. The actual reason is this is a status competition. And the reason we know that is the logic doesn't make sense, right? So first is these are pay packages to people who are functionally post-economic. I mean, Elon Musk will have to budget really carefully to live on an additional $29 billion a year. But realistically, it does not going to make any difference. His wealth is so gargantuan that this is just going to vanish into the sea of his hundreds of billions, as with all of these other people. So what it is a way of signaling from the CEO to his or her peers and from the board to other boards that we have the best. We have to keep these people around. But in fact, it does not make sense that the CEOs have essentially no reason to make this argument that if they don't get this pay package, they'll leave, right? Because these are already people who have unimaginably huge grants of equity in these companies. This is why they are post-economic, because they have these huge chunks. So let's say that Elon Musk walks away from Tesla because he doesn't get the $29 billion. Well, if Musk is as valuable as he thinks he is and the board thinks he is, then the value of his Tesla stock, the stock he already has, will collapse. And he will lose much of his own fortune. This is like a hostage taker, right? A hostage taker holding a gun to his own head and saying, if you don't give me what I want, I'll pull the trigger.
Yeah, I mean, and the Tesla compensation is probably one of the more egregious, particularly given that it's been approved at a time when the stock is a shadow of what it used to be. It's still obviously a healthy company with maybe some potential going forward. But when you go back to those all-time highs from last year and you look how much has fallen, why would you reward that? And that leads me to my question, Gautam. What are these pay packages intended to be? Is it a reward for the work that you've already done, or an incentive for the work that the board wants you to do?
I mean, I think that's what we're told they are, right? That there's supposed to be an incentive for the work that you're going to do, because you've been rewarded for the work you already done. That's why you're so rich already. But the story doesn't make sense, because the incentive already exists in the equity that you already have. So the only way this actually the only story that actually comes together for these pay packages is the CEOs are doing it for self-aggrandizement, right? That they're saying that I am so valuable, I can extract this from my company. But that's not what you want if you're a board, right? You don't want to be able to give humongous amounts of shareholder money to CEOs when you don't get any business improvements from it. And how can you, when none of the incentives change before and after you give this pay?
This leads to the whole idea, though, of why we haven't seen more pushback from shareholders, and for that matter, the board. And I think I know the answer on the board side. But, I mean, you have a lot of shareholders in these companies, and I am curious as to whether they think they're getting enough value for their investment in light of some of these billion-dollar pay packages.
So I think it depends on the company, right? If you are a Tesla investor and you've been riding Tesla, Elon Musk for so long, for a very long time, you've done very well. If you bought recently, you might not have. But if you bought 10 years ago, you are very, very happy. And at this point, I think we should sort of think of Tesla as kind of a meme stock more than a traditional stock, given all its things that go on around it. So if you're a Tesla investor, why would you push back? The meme is Elon, as he said, I am become meme. It's his own self-description. The logic varies in other companies, but I think the biggest chunk of this is we've become normalized to this. It just seems like a thing that happens where, you see the headline and it goes away. And our normal responses as people who exercise business judgment have just been dulled by this constant drumbeat of executive after executive gaining dynastic wealth.
Draw the difference for me, though, between sort of a founder getting paid this, and I know I know Elon Musk didn't found Tesla, but he was there pretty early in the process, and he's responsible for a lot of their success. But when you see David Zaslav get the types of pay packages he gets, so he's a hired gun. He's a good manager, but he's a hired gun. Why does he need to get paid that type of incentive?
So I don't think he does, right? So if a founder gets it, then a founder gets it when they founded the company and because they founded the company. And they have huge chunks of equity in the company because they've been in it for the whole time. You don't need to give them any more. It's their company. Bill Gates, during that whole time he was running Microsoft, wasn't collecting additional equity grants in Microsoft. What would be the point of that? David Zaslav is a different question, right? Where he is a skilled manager, but is there anything in his track record that suggests that he is a uniquely skilled manager? And it's hard for me to put my finger on what exactly, especially given that the merger that engineered is now being unwound. Does that seem like, a world historic business genius who's worth hundreds of millions of dollars? Yeah. I think you'd be hard put to make that case.
All right, Gautam, got to leave it there. Gautam Mukunda is a lecturer of management practice at the Yale School of Management and a Bloomberg opinion columnist. His latest column on outsized executive pay. Meanwhile, here on The Close, we keep an eye on the markets and the after-hour trade. That Cisco conference call underway right now. The share is still holding on to those losses after the earnings report. A similar story for Coherent, which makes a lot of optical components for the semiconductor sector. Those shares down 16% after a miss on a few key metrics and some concern about its guidance. But to the upside, if you're looking for a bright spot, you're going to find it in burgers. Red Robin Gourmet Burgers just reporting earnings, and those shares up 5% in the after-hours trade. This is Bloomberg. The market's record rally may be masking traders' concern around the lasting impacts of tariffs. That's according to Bloomberg's latest Markets Pulse survey. Respondents worried U.S. stocks could underperform global counterparts by the end of President Trump's term as a result of his trade policies. Tatiana Darie joins us right now, who helped to lead that survey. And let's start off with this idea of U.S. exceptionalism. That was all the talk a few months ago. How do folks feel about that now?
Yeah, a big theme in markets. Well, the survey is telling us that the majority of respondents think that the unwind of U.S. exceptionalism, which started back in February, is still on track as a result of his trade policies, which left the U.S. stocks behind global peers this year. I mean, let's not forget that behind the record rally and solid gains of about 10% in the S&P 500 this year stands underperformance relative to global peers. MSCI World ex-US, for example, is up 20%. So the S&P 500 is behind the rest of the world, is behind emerging markets, is behind Canada, behind Hong Kong, and in dollar terms, also solidly behind Europe.
And that's fascinating to me, too, because we talk about this idea of the potential negative impacts from tariffs and why that's weighing on sentiment. But we've also seen sentiment start to increase, and this seems to be tied more to this idea of the Fed lowering interest rates. And I guess some people think that might blunt the impact of tariffs. What did they say?
Yes, I mean, rate cuts would really be a game changer here, particularly if you look at other parts of the market that have been struggling, like small caps. We've seen a big rally there this week as those rate cut bets have swelled. And one interesting finding from the survey is that investors think that rate cuts as a result of Donald Trump's pressure would actually help stocks outperform because they would probably larger than we would otherwise get. And I think that suggests two things. Either that investors agree that lower rate cuts make sense at this point, as you know, we've seen a slowing labor market, a struggling housing market, so definitely pockets in the economy that warrant lower interest rates, or that if the president manages to do this in a way that maintains market credibility and doesn't hurt Fed independence that much, then the benefit would outweigh the risks in this case.
And that's a fine line to walk. Tatiana, Darie, who helps to lead our Bloomberg Markets Pulse survey. And speaking of that pressure coming from the White House, that pressure continued today. The Treasury Secretary, Scott Bessent, he was on Bloomberg Surveillance earlier this morning. He said the Fed should have already cut rates substantially.
We should probably be 150, 175 basis points lower. So, you know, I think the committee needs to step back. I think probably one of the most politicized governors just went off the board.
And those comments, along with the additional pressure, making bets on a September Fed rate cut, being ramped up on the heels of those comments, the heels of that inflation data, benign inflation data to be sure. Joining us right now is Andrew Levin. He's a professor of economics over at Dartmouth. He formerly was an advisor to the ECB, the IMF, and spent a couple of decades on the Federal Reserve, including as a special advisor to the board on market communication. And Andrew, I'm going to start with something that no one seems to be talking about. I sat there when Scott Bessent was getting the interview, right off to the sidelines. And my first question to myself is, why is a sitting Treasury Secretary even saying this out loud?
Well, it's a fascinating question. I was just checking this afternoon to look through the history of this. So over the last 25 years, it hasn't happened at all. And that would be, you know, really going back to the Bill Clinton era, George W. Bush era, President Barack Obama era. Secretary Treasuries did not comment publicly about the Fed's monetary policy. But if you go back to the 80s, and even to early 90s, it was not uncommon. And so we're talking here about people that are now considered distinguished secretaries of the Treasury. Donald Reagan, 81 to 85, James Baker, and then Nicholas Brady. And all three of them publicly critiqued the Federal Reserve's monetary policy at various occasions. Now, a lot of this was during the era when Paul Volcker was chair, and he was a towering figure. But there was certainly a view at the time that officials outside the Fed, including in some cases the president, if you go back to the 70s, but in the 80s, certainly the Secretary of the Treasury, were free to comment and to disagree with the Fed's positions. We just haven't seen it for a long time.
Well, I'm glad you provide that historical context, because I've heard this argument before, because when people talk about the politicization around the Fed, it's not necessarily new. There's always been outside pressure. We know that with hindsight. I am curious about the flip side of that, though. This idea that the Fed itself can sometimes be political. And there's been an argument made that whatever, whether it's true or not about Adriana Kugler or Jay Powell or whatever, this idea that in the past you did have sitting Fed members, not necessarily the Fed chief, but other sitting Fed members that were very political in their public communication?
Okay, so I think the right way to think about the Federal Reserve is like a team of doctors, and the U.S. economy is the patient. The U.S. financial system is the patient, right? And the team of doctors has to explain to the patient and to the patient's family, which we can think of if you want as the markets, and to Congress, which is the Fed's boss, right? The team of doctors has to explain their diagnosis, their prognosis, and their plans and the contingency plans. And I think of the Treasury Secretary as something like the sister of the patient. Okay, the sister has an MD, PhD, knows a lot about medicine. And in many cases, it works well that the sister can see the rationale for what the team of physicians is doing and doesn't need to comment. But in certain cases, where there just isn't, it's just not clear what the doctors are thinking and why they're doing things and what their contingency plans are. Any good sister would say, wait a minute here. And I think that's what did happen in the 80s. Sometimes the sister's wrong, and it turns out the team of physicians actually has a good reason for what they're doing. In other cases, they correct.
Yeah.
And so I think that having public debate about the Fed's policies is important. We're a democracy, what the Fed's decisions affects everyone. And I think part of the problem at the Fed is there just hasn't been enough debate for quite a few years, just not enough debate, even within the Fed, about the decisions.
Well, I'm curious about that. I mean, we're talking about an organization that, dates back, obviously, prior to the Depression, 1913, I believe. And of course, its independence kind of enshrined a little bit later in various legislation and regulations. Scott Bessent today made it clear he wants to see a broad review of the Fed's operations and its mandate. We heard something similar from Stephen Mirren, and there's some other members who could potentially end up on the Fed that have also made it clear they want a broad-based rethink of what the Fed does. Do you think that would happen? And more importantly, do you think it's appropriate?
I think it's absolutely appropriate. I myself have been calling for a comprehensive review of the Fed for 10 years. Some of these problems are not new. Some of them have just become much more in the spotlight recently. But let me just give you an example here. The Fed's mandate is maximum employment and price stability. And in the past, we always talked about doves and hawks. The doves were the ones who were more attentive to the job market, wanted to really make sure that the job market's healthy. The hawks were the ones who were attentive to inflation. It seems like the world's upside down right now because people who were appointed by President Biden that we would have expected to be really strongly attentive to maximum employment have been pretty quiet about it. And the people who've been appointed by President Trump, who you might have thought would be hawkish, those are the ones who are calling for rate cuts. So what's going on here with the data, I just want to emphasize here because it hasn't gotten enough public attention. The right measure, broad-based measure for employment is not the unemployment rate. It's the employment to population ratio. And I've checked that data. You can bring it up on your screen if you can, okay? Employment to population ratio peaked in 2023, and it's been coming down steadily ever since. Not because of tariffs, not because of other kinds of policy changes in the last 6 to 9 months, and not even policy changes last year, okay? It's been coming down steadily for a couple years. That clearly indicates that monetary policy is tight. Not that we're about to fall into recession, but that policy is tight. And so at a certain point, when the employment population ratio keeps dropping, and it has over the last 6 months, should be causing the Fed to have a rethink here about the risks to the labor market relative to the risk to inflation. And over the last 6 months, from January to June, there were no dissents at the Fed, no dissents. So the kind of public debate those team of physicians should have already been having hasn't been happening until very recently now.
Yeah, absolutely fascinating. We didn't get a chance to pull that up, but I'm going to look at that as soon as we go. We have to leave it there, Andrew, and this really does set up a very interesting Jackson Hole next week. I would love to be a fly on the wall there to see what they debate. Andrew Levin there, professor of economics over at Dartmouth and former advisor to the Fed. This is Bloomberg. From a former poker player to betting big on oatmeal. That's the story of our next guest, Brian Tate, the founder and CEO of Oats Overnight, a company that sells high-protein oatmeal that's prepped at night and ready in the morning. He joins us right now here in Studio 2 in New York. Great to see you here. We were going over some data, and apparently no one eats like breakfast cereal anymore. But then I saw there was sort of one exception in those statistics, and apparently we're still buying sort of pre-made, if you will, I guess for lack of a better phrase, kind of hot cereals, like oatmeal. Why?
So consumers are looking more and more for convenience and real food nutrition. They're shying away from those sugary breakfast cereals that we all grew up eating and reaching for that whole food option. We find that convenience, taste, and nutrition are critical. Taste might be the most important one, and we feel we really thrive on all three.
So your packaging, though, I mean, when I pick up a package off the store shelves, it's basically dried, right? I still have to put in the water?
Yep.
Okay, so what separates your product from just, I guess the old school, I'm just probably dating myself, kind of the Quaker Oats that I grew up with.
Yeah, so nutrient-dense food is on the rise. Of course, consumers are looking for more protein in what they eat, and we deliver that fiber with 20 grams of protein, not giving up the convenience. You can eat this spoon-free on the go, which makes for a very easy morning.
Spoon-free.
Exactly,
so
it's almost a drinkable oatmeal. Very, very unique format, but our customers love it.
Are you finding that you're getting more interest given some of the trends with regards to GLP-1 drugs and the idea that if you are taking those weight loss drugs, you have to be more mindful about fiber, about getting enough protein?
Absolutely. So nutrient-dense eating is also on the rise. We feel this is a mega trend, and our product really, really fits it nicely, as well as 10 grams or less of sugar.
We have a lot of folks in the small business world on this program, primarily to talk about just what business is like these days. What is the health of the consumer, particularly for your product?
Yeah, so we feel that the wallet share is shifting, of course, maybe a little less snacking, more intentional eating. Also, the convenience is so critical, and so it's got to fit all those three things, and consumers are really prioritizing that convenient morning.
But you got to buy the raw ingredients, you got packaging costs, you got marketing costs. What do those costs look like right now? Are they under control?
Yeah, for us they are. We own and operate our manufacturing, so we have 400,000 square feet of manufacturing between Arizona, our HQ, and Ohio. 300,000 of that is in Ohio, 500 employees, all packaging this, procuring it, all the quality and R&D is done in-house.
So this is made in America?
Absolutely, yep. A big fan of U.S. manufacturing, yeah, absolutely. And we source most of these ingredients, 500 different raw materials, all domestically. So a few different points of exposure, oats from Canada, which are exempt, so very minimal tariff exposure. We've actually been able to operate the last 4 years without raising price, which we're very proud of.
What's your ambition? I mean, what does this become beyond your current lineup? What do you see?
Yeah, so we see these trends persisting. We're playing in a $20 billion total addressable market, and so we're very excited about the future. And we plan to continue building, high protein options that are convenient and taste great.
Are you worried at all about competition?
We have a bit of a moat on our manufacturing front. It's hard to make this. We've gotten very good at it, and we see a lot of other competition in the space, smaller startups. But we're pretty excited about the offering and the unique benefit we offer to our customers.
What's harder, running a consumer products company or being a poker player?
I'd say consumer products. I enjoy this more. It's a little more dynamic. I don't have to sit at a poker table for 12 hours a day. It's a nice twist.
Brian Tate, it's great to meet you. We got to get you back on for a longer conversation. That's Brian Tate. He's the founder and CEO of a company called Oats overnight. We appreciate you joining us here on The Close. We'll be back tomorrow, same time, same place. And of course, tomorrow we will have fuller coverage of a lot of that economic data, including the latest read on PPI, as well as the latest earnings. For all your political coverage, stick around. The team at Balance of Power is up next here on Bloomberg.